Hi, I'm Karl Kyler, your San Diego Realtor, and in this week's interview, we are interviewing Matt.Kish from Movement Mortgage. We're gonna get the inside thoughts. You guys always hear about what's happening on the real estate side. Now I'm bringing to you a phenomenal professional that's local here in San Diego. So if you're looking for a loan or refinance, you can call this guy directly. I have his info in the description below, but we're getting the loan perspective, the loan side of what's going on in the market. So Kish, how about you just introduce yourself, tell us a little bit about you, and then we'll jump into these questions that the audience is probably gonna be dying to want to hear about.
Yeah, for sure. Thank you for having me here, Karl. My name's Matt.Kish. I'm a loan officer with Movement Mortgage locally here in San Diego. Been doing it with Movement since 2020. So I'm at my 5-year mark here next month, actually with Movement. And then I was actually a loan officer from 2005 to 2007. So I got to see kind of both ways of doing loans back in the Wild West. And now that it's a little better and better served legal and licensed. So being a loan officer, helping the communities we serve here at Movement Mortgage is definitely why I stick around and why I still do what I do. So I appreciate you being here and bringing me on. Much appreciation.
I appreciate you being here. And we actually started about the same time. So I started in 2004. I was around as well during that whole huge disaster of a real estate market. So let's jump into the big questions. This last week we had GDP report, we had the unemployment report, and then we also had a PCE report, which it came down just a hair. So the Federal Reserve's dual mandate of getting inflation PCE down to 2% while maximizing unemployment looks really, really good right now. So can you tell us about what you are seeing happening to the loan side of market as all of this data is coming out?
Yeah, so, like you said, all these reports came out, and the BLS jobs report came out today as well, kind of combating that unemployment number. But again, these numbers with the BLS are being revised as we speak, right? So the job number today came over expectations by 47,000. And so you saw the bond market react to that today negatively. But the thing about these BLS numbers, the Bureau of Labor Stats, is they're being revised. So February is already being revised minus 49,000 jobs out of the February report. And then already in March, it's being revised. 43,000 jobs came out of that report already. So if you take that into consideration, they're basically right on the mark where they're looking at the unemployment numbers. So you're going to see that pretty much right on the number as well, just like you said. So I'm hoping these numbers get corrected quickly and we see that reflection in the bond market, but that's yet to be told. But with negative GDP, that means the economy's shrinking. That means everybody's about to pucker up, right? It's the banks and the consumers. So both sides, it's the double-edged sword there. So you're going to see a lot of tightening up on the spending side when it comes to consumers. So you're going to see big investments. You're going to see loans, right? You're going to see the housing market kind of slow down. You're going to see investment, the large purchases. You're going to see people stop buying motorhomes, boats. You might not see the financing going on to buy that ADU anytime soon because people are going to batten down the hatches, and banks are going to do the same, right? Banks are going to tighten down what they're doing as far as underwriting and who they're lending to. Right. So you might see prime borrowers get rewarded a little bit because of this economy, but you're going to see those high risk borrowers either having to pay more or being underwritten right out of the process with the tightening. Right. And then the PCE being down as well. That's a major part of the economy. So you're going to see people cutting back. You're going to see higher costs possibly. And you're just going to see less demand for borrowing because people aren't going to want to put their necks out there with the unemployment numbers being what they are, and with these, the negative GDP being what it is going into Q2.
Just to recap, you're suggesting that the BLS, Bureau of Labor Statistics, these numbers, they always go through the revisions, and there always is a revision. So you're suggesting that unemployment is coming down, but the numbers after the revisions, it's kind of still a little sticky around 4.3-ish or something.
Right. It's going to stay flat. Again, the numbers today came out like, oh, wow, it's way over the mark. but as they're being revised, you're going to see it a lot closer to the market than not, right? So as you said, they're right around 4.2 as they sit today. So what does that mean? What's the net effect on the loan market, right? So borrowers, you're going to face, stricter standards. You may have to pay higher interest rates, because everybody's tightening up, and the demand of mortgages, auto loans, business loans, they're going to dip, right? Lenders are going to increase provisions, right? They're going to cover their behinds in case of default, knowing that the economy is slowing down a little bit. And then interest rates, right now, they're going to be on the higher side until the feds decide to lower, right? Because of the adverse risk that we're going with slowing economies.
Got it. This is a really, really good insight. So for probably, and correct me if I'm wrong, we're probably sitting close to somewhere between 6 to 8 weeks of mortgage interest rates, based on the, what is it called? The, what is that app that you guys use that shows the rate every day?
Mortgage News Daily.
Yes. So Mortgage News Daily has been reporting rates sub 7%, probably for somewhere between 6 to 8 weeks. You're suggesting because we have negative GDP and PCEs coming down, that's suggesting that the economy is puckering up, language you used. We're having banks are going to tighten up their guidelines, which makes sense because they're trying to mitigate loss, being the fact that the economy isn't doing as well. It makes total sense as you say that. So you're suggesting that because of all of this, it's kind of the like negative news in regards to like the trajectory of the direction the economy is going. Are you suggesting that mortgage interest rates may curve upward then?
I would imagine they stay more flat than everybody expecting them to come down right away, right? But as we saw, and as I believe that we'll get to further down the questioning, we saw that a day of news, good, bad, or indifferent, could sway these markets as well, right? So these are the factors that really cut into it. But again, every day, especially in these last kind of 100 plus days, has been a mixed bag where one day of good news or bad news could sway the way these bond markets react.
Gotcha. Okay, that makes sense. I was always thinking or under the impression that as volatility or concern, I shouldn't say volatility, but concern towards the productiveness of the economy, that would have more people going into safer investment options, treasuries and such, which would bring those down, and that would also bring mortgage rates down. Though that might be possible, what you're kind of forecasting right now is more of just like kind of a flatlining. We're probably just going to stay that hair underneath 7 is what you're suggesting?
Correct. Until unless Q2 has the same results as Q1, and then the Fed and the government are going to have to switch the way they are doing economic policy, which will, down the road affect interest rates.
Okay, cool. Very, very good. So next question, I think this just begs the question. It's a perfect lineup. PCE is slightly coming down. If we have Q2 report again negative, that'll be officially by definition termed as a recession, or we're in a recession, 2 quarters back to back negative GDP. Is that correct?
Correct. I mean, in general, but there's other definitely indicators that will point that as well. But traditionally, 2 quarters of slow economic growth is pointing to the recession. Correct.
Perfect. So at that point, we have 2 quarters. Hopefully PCE will hair its way down. If that's the case, what do you see happening to the loan side of the market after that? If let's just presuppose that Q2 is going to report negative, what do you foresee happening to the loan side of the market after that report?
Yeah. Again, they're probably going to have to switch the way they're looking at the policy, right? But this is what we know about the Fed is they switch their policies and monetize policy by looking in the rear view, right? So they're going to need to see the data before they really, really switch gears. Yeah, they'll have pressure from the government, they'll have pressure from outside noise, but the Fed, as we've seen, really makes their move by lagging data and lagging support in the rear view. Right. So they're going to really need to see a year of what's going on with the data before they make their move, or 6 months, or however they're compiling their next move.
So pretty much what we're waiting for is we're looking for a little bit more kind of, I'm trying to be mindful of and sensitive of the words I choose here. If we have a Q2 negative again, that's probably going to sound a lot of alarms and a lot of clickbait, YouTube thumbnails of recession, crashing markets and such. At that point, would it be enough to tip the scales for the Federal Reserve to say, okay, now it's time to start cutting the federal funds rate? Because I feel like even though that doesn't have a direct impact on mortgage rates, that's what a lot of buyers are looking at. And they think that it will have this impact on the mortgage side. Do you think that Q2, if those numbers come down, it would be enough for policy to change?
Again, that all depends, right? But if we really want to look in not so recent past, right? What happens when the Fed cuts rates is everybody was waiting for that in October. Remember, we're on great trajectory going through the summer with interest rates. Interest rates were coming down. Everything was looking great. And then the Fed's going to cut rates, the first meeting in October, and mortgage rates fell off a cliff. And we haven't got back to that level since Fed's cut rates. They cut rates in November as well, if you remember. The mortgage rates dipped again. So these rate cuts from the Fed don't always directly affect mortgage rates. And actually the inverse happened the last Fed cut. So they could help. But when the Fed cuts rates, what they're doing is they're cutting rates for banks lending to other banks, not what banks lend to you.
Got it. I love that you reaffirmed this position, because so many buyers that I come across where I don't have the depth of the relationship with them to say, hey, this is how the market works, and they don't have that trust in me yet. A lot of them will say, well, I'm waiting for the Feds to cut rates. I'm waiting for the Fed to cut rates. And that trust and that relationship isn't deep enough for me to say, hey, well, let's have a conversation about that. So pretty much we really don't know what we're swinging at come after Q2, if the Fed cuts rates and how that will affect mortgages. So let's just move on to the next question, I think, all things considered.
Right. Or if you want for a second, let's play the hypothetical card just really quick, right? Say recession, everybody's screaming recession and it goes bonkers, right? So what happens is Fed's going to cut the interest rates. People usually move out of the stock market and get into the bonds, right? Which is going to drive the bond yield down because it's a safer bet. Treasuries are a safer bet than the stock market longer term. And, once more people are in the bond market, it's going to drive the yield down, which will inherently drive the interest rates down as well, right? So the fixed rate mortgages are going to be good, but what's going to happen is your interest onlys and your adjustable rate mortgages, they're going to be through the roof in pricing or just flat out unattainable for a lot of people. It's not going to be an instant thing either. Like we talked about, once the recession hits, it's not going to be like, oh, recession Q2. So come Q3, interest rates are going to drop. It's going to take a lot of time for that to happen. But even when it does, right? Perfect example, like we were talking about, we were back in the 2008 days, is even if interest rates come down to a certain point because of these, extreme measures as far as the market coming, contracting, underwriting is going to be extremely tough. So even if you were pre-approved prior, you might get underwritten out. And a great example is people in hospitality, people in retail, right? Where these seasonal incomes, whether you're in retail and you get a big bonus around Christmas time, or you're bartending and summer is when you get paid a lot. Underwriters going to look at how you get paid differently, and you might not be able to qualify. So lower interest rates, and especially in a recession, doesn't always mean good things.
That's a very, very good perspective to share with us. So even if rates come down, if there's concern in the markets, less buyers, or I should say buyers will be more challenged or required to qualify at higher standards.
Well, especially adverse, right? If you got low credit and you don't have reserves, and your job is a variable and you're not salaried, it can be really tough for you to get a loan.
Gosh, that just tees up my next question I had in my head so well. It sounds like there's a lot of opportunity to get into the market now, considering the fact that we haven't tipped into that market of concern of recession, red lights and everything like that. And there's tons of data out there where an economic recession doesn't always lead to housing prices coming down. I think that's what a lot of people are expecting. They're thinking the recession is going to be the next 2008 crash, when I think that those two words are radically different. 2008 crash has its own definition, and then recession has a radically different definition. A lot of people are like hoping or expecting that that's going to happen, but it's going to come with higher or I guess heavier conditions to qualify. So if we look at the market right now, what are you experiencing with buyers? Like with the concerns of GDP and PC and unemployment, and especially with tariff talk and Doge out there, like what are you hearing from buyers in the buyer's market that are looking at homes right now?
It's, to get back to what we were previously going at with all the fears and stuff like that. And we just don't know. Like we said, yeah, these are all the indicating factors of the market and the economy contracting. But like we talked about too, one day of news could sway this whole thing. One person's speech or a group of people lobbying against a certain thing could sway the pendulum more so than we've ever seen before. Social media being a big factor in that. But the difference between the recession now and the crash of '08 and the rates coming down after is equity. The reason the crash happened in '08 is because people were getting predatory in loans that they couldn't afford with no equity, right? The difference now is people have equity built into their homes, especially in San Diego, after getting lower rates and refinancing in 2020, 2021. There's so much equity. So I don't see the big movement once rates come down, right? And if you are going to be getting into these properties, you're going to pay for it.
So are you finding a lot of buyers with all the chatter about the economy and the market right now? Do you find a lot of buyers hesitant to move into the market? Or like my experience with buyers recently, it's been so crazy. I have buyers rushing to get in. I just closed this wonderful couple. We closed in Del Cerro. We ended up having to bid $175,000 over asking price. Now, mind you, the listing agent was very aggressive with the list price. She probably could have listed it for $100,000 more, but that's her strategy. My clients got it, but we were one of 10 offers competing. And I worked that listing agent like there was no tomorrow to make sure that I had the inside word on everything. Do you find that same, like across the board with all the agents you work with across all of San Diego or California and all the areas that you lend, are you finding buyers rushing to get into the market, or are you finding them tending to like have reservations? Are they sitting on the fence? What are you experiencing?
So it's a mixed bag, right? There are people who are savvy and pay attention to these things that we're talking about and really ready to get in. So they could get in now before the refi boom comes in. Great borrowers and buyers to have, right? But I'm experiencing a lot of first-time home buyers right now. Most of the buyer pool got sucked up when the rates were low and affordability was a little different in 2021. So the buyer pool we're left with right now, first-time home buyers, inexperienced home buyers, buyers that are very hesitant to enter the market with rates being high and with cost of living being what it is, right? Especially first-time home buyers, the big pool is condos right now, and condos have their own special niche of things going on with them and their HOAs and stuff like that. So there's a lot of hesitancy I'm seeing, but that's okay. Like that's our job to educate, talk them through any fears, anything that's holding them back, other than obviously them not being able to afford it. If you can't afford it, you can't afford it. You shouldn't be buying a place, right? But if you can afford it, you've got great credit, you've got a good job, the factors are there in your favor. There's no reason for you not to be in a property. But again, like you said, all the fear is really keeping what I've seen in the past few months, making people really hesitant.
With mortgage rates the bit of the roller coaster in April, we saw them get pretty close to 6.5%. We've seen data in the past that when rates get close to that 6.5%, mortgage applications bump up. Are you finding that the case since we got below 7%, and then also when we got kind of close to that 6.5% in April? Like, are buyers so sensitive to mortgage interest rates that we see a jump in buyers coming in, like to try to secure that rate, or are you experiencing something different?
it's kind of different. Buyers, everybody got really interested in, that finite period of time. And I'm talking finite period of time. I think it was like a Friday to a Monday, to where the rates got good. And it goes back to a little bit of news, or news that didn't end up being true, really swayed that pendulum. It was, the office is backing off of tariff talks, and the market really reacted to that. Then, the weekend went by, and the White House came out and said, no, by the way, that's not happening. And then the market really reacted to that. So it's a roller coaster. Look at that. In a couple of days, rates could be from the low sevens to the mid sixes, and then jump right back up to the low sevens within a week, right? And being in the lending industry, that makes it pretty tough for us. But I didn't really see it as far as purchases were concerned, but we really are looking for the next refi boom too. So I got on the phones and I was getting people super excited about the trajectory of what I'm looking at, only to get the rug pulled out a few hours later. So that's the way it goes. That's the roller coaster we're living. But when you're talking about a roller coaster, it's an actual roller come that last month and what happened, the rates being what they were, the rates get really good really quick, and then going right back up just as fast.
It's interesting that you mentioned the refi boom, because a number of my clients that bought in the last year, maybe 18 to 24 months, a number of them are getting refis, and they're coming down that quarter, probably closer to a half a point, and it's making a big difference for them. All things considered, if we look at mortgage interest rates, where the direction of the economy is going, how are you advising buyers today? What is the conversation you're having with buyers to advise them on the appropriate direction to move forward? Like if they should hold off, or if they should go forward, or what information are you educating, conveying, sharing with them that allows them to feel comfortable, confident with either moving forward and getting an offer, or getting out there and start shopping for a property, or maybe it's the information they need to say, you know what, maybe right now is not the right time. Let's sit back, reevaluate our finances, set up a different plan, and then recheck in with Kish down the road.
Yeah, it's always about making their numbers visible and touchable and tangible, right? I could spout numbers all day long and gonna just leave you in the dust. But until you see what it looks like, what your transaction looks like as if we were in escrow today, you're not gonna really know what happens. And my team and I have great technology mortgage coach that goes through that. We use the MBS highway to give us the tools there. Cost of waiting, especially, is very relevant to what we're talking about right now. I have a great tool that shows you, hey, this is where you're at right now today. And if you wanted to wait until your hypothetical interest rate months, a year down the road, what does that look like side by side, apples to apples? And then you get the educated choice for yourself if you want to wait, lose out on the appreciation just to gain that extra half point in interest rate. Is the juice worth the squeeze? Maybe it is, right? So we have that great technology, but right now, like I spoke about earlier as well, is a big pool of what we're dealing with as far as our borrowers is first-time home buyers. So they have to be educated, right? And what does it take to get a home loan in general? It's credit, it's collateral, and it's capacity to repay the loan, right? Credit's credit. It's how are you paying your bills? Are you paying your bills on time? Credit, right? That's the hurdle you can't get over with the other two. Collateral, where's the money coming from for your down payment and closing, right? Is it coming from a 401k? Is it coming from savings, checking, a gift, a grant from a nonprofit? Got to source the money. And the capacity to repay the loan. Your job, right? Is your debt to income? Do you have any debts? Are you paying on those on time? What are they on a monthly basis concerned to what you're looking for in a mortgage going forward, right? And that's it. Making sure those 3 C's are dialed in their heads: credit, collateral, capacity. If you qualify with those 3, we need to talk about what that looks like in numbers, in terms going forward as far as a purchase. And making sure everybody's educated is it. Making sure they walk out feeling like they're the loan, feeling like they can take their loan and go. That's my job.
I love that approach. It's about educating and empowering them to make a confident decision to move forward. And then that way they're never looking back in the rearview mirror thinking, questioning their decision to either buy or hold off. I love that approach, and I love how you serve your clients in that way.
Yeah, and it's always a very conservative approach too. When I'm printing out these numbers and these estimates for them, it's always a conservative because I never want these numbers to jump up on. I only want them to come down. And so when you see the numbers in our estimates, they're always usually a little inflated just to make sure everybody is absolutely comfortable with this process.
That's a good way to prep. I kind of do something very similar where I buffer my clients by rounding up. So that sounds like a very, very similar approach. All right, that's it for this interview. Kish, thank you so much. I always say Kish. If you're watching this video, his name is Matt.Kish. I just say Kish. Kish, thank you for being here, helping to provide that other side of the conversation, the other side of the market that buyers and sellers want to hear about. So thank you for showing up, sharing that with us. I am going to drop Kish's contact info in the description below. He's with Movement Mortgage. I've known him for years. He's worked with tons of agents that I've worked with. We've done a lot of collaboration on a lot of projects and deals and such like that. He's absolutely phenomenal. And again, if you're looking to educate yourself, Kish is a phenomenal resource. I'm going to have his phone number and his email in the description below. Feel free to call him directly or text him, and you can also email him if you want to be, I don't know. Some people just prefer to email. That's fine. Email him first. Any thoughts, questions, concerns before we close out, Kish?
No, just very much appreciate the time. Feel free to give me a shout, man. I'm here to be on your team. I'm not here to sell you. Obviously, we're all in sales, right? But I'm here to educate. I'm here to make sure you have the best decision for you and your finances, for you and your family going forward. That's all. I'm here to help. Please use it.
Wonderful. Thanks again, Kish. I will have Kish on my channel twice a month, updating you with everything that's going on in the loan market and how you can use this information to fuel your next decision, either to buy, to hold, to sell, whatever it is you want to do. Thoughts, questions, concerns, don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.